Okay, today's lecture is called Responsibility Accounting and Decentralized Operations. And we got a couple of topics at the tail end about the balanced scorecard and transfer pricing. But these first two are the main topics here. Companies can be very centralized, they can be very decentralized, and anywhere in between. Most companies have an organization chart that looks like a triangle. Now, I didn't put it on the top here, but you would see on the top, especially of publicly held companies, board of directors. They'd be at the top of the triangle because they're the ones who make all the long-term, what we call strategic decisions, in terms of the path the company's going to take, what they're trying to accomplish, their mission statement. And they can also hire and fire top-level management, including the chief executive officer, who's at the tip of the organizational chart. Okay, now, in a centralized operation, you see many layers of management. And in a centralized operation, all big decisions and some of the not as big decisions will be made towards the top. Okay, you have to run it up the chain of command, as they say. Whereas in a decentralized operation, it's a flatter organizational chart. You have less layers of management, and that's because they've delegated responsibility and decision-making to lower levels of management. Now, when you have a decentralized operation, there's greater risk involved because you have more people who are now making decisions on utilization of resources, money, purchasing, investing in equipment, that type of thing. So when you decentralize, you need to make sure that the people you are delegating authority to have been properly trained and have demonstrated the ability for sound decision making and that they can handle an increased level of responsibility. Okay, so there is risk involved in decentralizing because more people are making decisions, but overall, companies that do a good job of decentralizing have several advantages. Let's just take a look at the slide. Some of the advantages of decentralization, it says, notice it allows managers closest to the operations to make decisions. That means you can turn quicker. You can make decisions based on market data, customer feedback, competition, and you're not waiting to hear back from headquarters, which may be in a different city or a different country. So you can move faster, and that's really important. Provides excellent training for managers. It allows them to become experts because they're allowed to make decisions and they fully invest in the operation. It helps retain good quality people. Good quality people want to take on the challenge of more management authority. They want to make more money. They want to feel like they're part of it. Okay? Improves creativity, customer relations, because you can respond quicker to customers. And very few organizations have one person who comes up with all the creative ideas. Okay? The more people involved, the more variety, and you're just going to have better creativity and better problem solving when you have good quality people who are able to make those decisions. A couple of disadvantages of decentralization is that depending upon how you reward managers, you could create something called goal conflict. Okay, and we talked about this in a previous lecture. Okay, decisions made by managers may negatively affect the profits of a company. For example, if you simply define sales commissions based on sales without saying, yeah, but they have to be to qualified customers who then will pay us. Okay, so if you just say you make a sale, you get a commission, they're going to go out there and they're going to run up the sales, but if they're not qualifying them as being creditworthy, then you may not convert to cash, and ultimately your cash flow will suffer. And so that's a problem for the accounting department and the overall business. Another example we talked about was if you cut the budget of your tech support team, for example, their phone budget, the quality of tech support is going to go down, and that's going to hurt your overall business. So companies have to be mindful of this and set goals and terms of performance compensation. Make sure they're carefully measuring it so it doesn't create this goal conflict. Okay? And there's some inevitable duplication of assets, procedures, resources when you delegate authority. Okay? So sometimes we will centralize certain types of operations. Other times you'll simply duplicate some of the operations, and that's simply inevitable when you delegate authority. Okay, now in responsibility accounting, we have three areas in which we evaluate performance. We have cost centers, profit centers, and investment centers. Let's just look at the definitions for each of these. Cost center, as the name cost would suggest, you're responsible for costs or expenses only. So the maintenance department, if you're maintaining a fleet of vehicles, it's a critical function, but you're not generating revenue, so you shouldn't be evaluated based on revenue. How well you contain costs and how efficiently you operate your particular department is how you should be evaluated. Okay? And so responsible for costs only. Some example of cost centers. A profit center is responsible for revenues and costs, and therefore profit, revenue minus expense. Examples. A department within a department store, like the men's clothing department in JCPenney. The manager can do certain things in terms of staffing, training of staff, how they have the appearance and the cleanliness of an area, how conducive is it to customers. So they can do certain things to enhance revenues as well as containing costs within their department. That would be a profit center. A restaurant, for example, Applebee's. Now, Applebee's has hundreds of restaurants all over the country. Okay, so a particular restaurant in your location, that's a profit center because the manager didn't pick the location. They didn't pick the size of the store in terms of square footage, as well as some of the big equipment decisions. Okay, but they're involved in day-to-day operations. Okay, so they can control revenues and expenses to an extent, but they are not an investment center. Okay, another example would be service department in an auto dealership is a profit center. Okay, and if you may be saying, well, wait a second, how do they affect revenue? Well, after you buy a car and after it's beyond warranty, if they do good quality service and quick turnaround time, you bring your car back to them as opposed to somebody else. An investment center is responsible not only for revenues and costs, but investments in assets, like fixed assets. Okay, notice it says, usually this is at the subsidiary or division level. So a division or subsidiary of General Electric, for example, the jet engine division. That's a separate company within General Electric. When GE prepares financial statements, they consolidate all the divisions and subsidiaries into one consolidated set of financial statements, but the jet engine division is evaluated as a separate company. Same thing with Chevrolet or Disneyland versus Disney World. So these are investment centers. The people in charge of investment centers have a lot of authority. This is high-level management because they can make big decisions in terms of where we drop a location, how much it's going to cost to build that factory, that theme park, whatever it may be. Okay, cost center. You're responsible for costs. Notice we have to differentiate between a controllable cost and a non-controllable cost. And when we say controllable versus non-controllable, we're referring to a particular manager. Now, at the top level of management, all costs are controllable. Because at an investment center, all costs are controllable. But at a more local level, department manager, restaurant manager, certain costs like property tax, insurance on the property, depreciation on the property are out of their control because they didn't pick the location, the size of the store, etc. But cost of labor, cost of utility, materials, etc., that is within their control. So we differentiate between controllable and non-controllable costs, and you should only evaluate performance using controllable costs. Okay? And as we saw previously, we'll compare budget to actual performance, and we'll explore variances. In a profit center, since we're evaluating revenues and expenses, we have a more involved evaluation. Let's take a look at the slide here. Okay, control revenues and costs. Now, some revenues are within their control. Other types of revenue based on, for example, a national advertising campaign is not really within a local store manager's control. Okay, common costs, such as service department costs, we have to ask, are they traceable to that particular department? Or are they what's called a common cost, which is a cost that services multiple departments? And we'll give you examples momentarily. Traceable service department costs should be allocated based on the amount of usage by a profit center. Examples, payroll, employee training, purchasing, quality control, testing, etc., where they're servicing multiple product lines or departments, then we could say, well, how much time and energy and activity did quality control testing incur to service this product line or this department? Same thing with payroll, in terms of the number of paychecks cut for employees. Common costs, generally speaking, are not traceable, should not be allocated to a profit center. Examples, property tax and insurance on a factory which may manufacture several different products. So we're going to incur that cost whether we discontinue a product or not. We're still going to have the big factory and the related costs. Okay, so common costs, generally speaking, don't get allocated to profit centers. All right, let's take a closer look at service department costs. The allocation of service department costs are based on the usage of the activity or service provided to them. Okay, so some examples here. ABC's service departments and the expenses they incur for the year are as follows. The purchasing department, we purchase raw materials and parts for all the different divisions and product lines. We centralize payroll, okay, and then we send checks to the different departments. So if a department has 500 employees, payroll is going to spend more time servicing them on this department than if this department only has 75 employees. So we would charge more payroll to the larger department. Same thing with legal. If legal's spending more time on legal issues affecting one department or division than another, we should charge the division which required more time and energy from the legal department. So how do we do that? We have to identify what's called an activity base. Now our company, ABC Company, has divisions X and division Z. We'll try to keep it simple. Now for purchasing, purchasing places purchase orders. So we would use either purchase orders or purchase requisitions. A requisition is a request for the purchasing department to place an order. Each purchase order is supported by a purchase requisition. So we can use either one. Payroll, the number of payroll checks they cut, or the number of employees would be the activity base. Legal, the number of labor hours, or the number of billable hours. Okay? And so this is a good introduction to what we're going to see a little bit later called activity-based costing, where we're going to take a closer look at overhead costs and other costs and analyze them individually instead of pooling them all together and coming up with one individual overhead rate. More on that in a different lecture. Okay, so purchasing has a total of 40,000 purchase requisitions. 25,000 were for Division X, 15,000 were for Division Z. So what we do is we say, well, if $500,000 was incurred by the purchasing department, and this is not for inventory or parts. This is the salaries of the purchasing department employees, the computers that they have to use, the furniture they use, the utilities that their department uses, the square footage they take up in the office building, all those related costs came to $500,000. They placed a total of 40,000 purchase requisitions. So that comes to a cost, even though it only takes 30 seconds or a minute to place a call to a vendor saying, hey Joe, send me 5 cartons of this product. The fact that we have a full-time employee with benefits and a computer and a desk, it costs us $12.50 per purchase requisition. So I need to allocate this $500,000 to divisions X and Z. And I'm going to do that based upon the number of purchase requisitions required for each division. So I'm going to multiply 25,000 times 1250. And I'm going to multiply 15,000 times 1250. Okay, and we'll see in a later slide what that number is. I don't have the number offhand. Okay, but this is for X, and this is for Z. And that's how we're going to allocate purchasing, and we're going to do the same thing for the other 2 service department costs. Here's payroll accounting. We cut a total of 15,000 payroll checks, 12,000 employees in Division X, 3,000 in Division Z. So again, X should be charged more of that $150,000 than Z. So $150,000, again, these are the salaries of my payroll employees, their computers, desks, utilities, etc. $150,000 divided by a total of 15,000 checks we incur a cost of $10 to cut each payroll check. I'm then going to do the same thing. I'm not going to put it on the board. We'll see it in a later slide. I would multiply 12,000 times $10. And I'd multiply 3,000 times $10. And that's how I'd allocate the $150,000. We'll see the allocation momentarily. Last service department charge is legal. Our legal department and the attorneys they cost us $250,000, same analysis, cost of labor, office space, etc. They spent 1,000 hours in the course of the year. 100 hours went to X and 900 hours went to Z. So now Z is going to be charged the bulk of this $250,000. So $250,000 divided by 1,000 labor hours is $250 per hour. I'm going to multiply 250 times 100 hours, so 100 hours times 250 for X, and 900 times 250 for Z, and that's how I'm going to allocate the 250 in total service department charges to my two divisions. Okay, and here it is. My purchasing cost of $500,000, $25,000 times $1,250, $312,500 goes to X, $15,000 times $1,250, $187,500 goes to Z, $312 plus $187, there's the $500,000 allocated. Okay, payroll, $150,000, based on the cost per paycheck times the number of employees. I believe it was 12,000 for X, 12,000 times 10 was 120,000, and 3,000 employees for Z times $10 per paycheck, 30,000. 150 gets split 120 and 30. Legal department was $250,000 divided by 1,000 labor hours, $250 per labor hour. Okay, for X, they used 100 hours. 100 times 250 gives us 25,000. Z used 900 labor hours. 900 times 250 gives us 225, and there's how we split the 250, 25 and 225. Total service department charges of 900,000. Division X, you add up the three numbers, comes to 457.5. For Z, add up the three numbers, comes to 442.5. Okay. Now remember, if this didn't make complete sense to you, hit pause, rewind, look it over again, think about it before you move on. Now, I just made up these numbers to illustrate how we would evaluate each profit center, Division X and Division Z. So if revenue for the two divisions were as follows, okay, then I have my variable costs, variable cost of goods sold. Remember, cost of goods sold, direct materials is variable, direct labor is variable, and then we have variable overhead and fixed overhead. So with a contribution margin format income statement, I'm going to put my variable costs first. So variable cost of goods sold for each division, variable selling and administrative costs, my operating expenses, gives me the contribution margin. And then my fixed costs, first I'm going to list my service department costs because those are traceable to each division. So if I can trace them to a division, I charge the division. Okay, there they are. You saw those numbers from the previous slide. And that gives us, sometimes we call this segment margin or controllable margin or simply income before common costs, common or non-traceable costs. And notice how we treat the common costs. We don't allocate the $300,000. We charge it to the company as a whole. So if I'm going to evaluate performance on Division X and Z, I use income before common costs, or segment margin, controllable margin, whatever your textbook may call it. Okay? Total operating income for the company is $2.3 million in this example, but again, I did not allocate the non-traceable common costs because that's out of the manager's control. And that could have a demoralizing impact on our managers who are seeing their bonuses and commissions drop or salaries because of charges that are out of their control. Okay, so you have to bear in mind the morale of your employees, and this is a better management method of evaluating performance. Okay, now the largest type of responsibility center is an investment center. They're responsible for not only revenues and expenses, but investments in assets, like building a factory. That could cost tens or hundreds of millions of dollars. When Intel makes a fabrication plant, it costs them $2 billion per plant. That's a big investment. When United Airlines has to invest in planes, this is typically in the hundreds of millions of dollars, since they don't usually buy one plane at a time. Okay? So again, this is typically a subsidiary or division, but notice it could also be by product line, it could be by geography. If I'm Apple, I have the iPad line, the iPhone line, the iPod line, the iTunes. These could all be investment centers. Okay? We're going to use two methods to evaluate performance: the rate of return and residual income. Rate of return, and it's a formula, so you want to know this formula: operating income divided by investment in assets. Now I want to read this note here and make a comment. Depending on your textbook, investment in assets can be defined differently. Okay, so investment in assets or invested assets, it could be end-of-year assets. It could be average assets, which is beginning January 1st plus December 31st ending, divided by 2. Notice it might be total operating assets, which excludes investments in land held for speculative purposes or equipment that's still on the books that is not currently being used. So that formula can differ. And if you remember back from financial accounting, rate of return was net income divided by average assets, or whatever your textbook you use might have had. So in the world of financial ratios, you're going to see a lot of flexibility. The good news is, whatever book you're using, use the definition in your textbook, and you will be tested on that particular formula. Okay, let's take a closer look at the rate of return. We said the rate of return was operating income divided by investment in assets or invested assets, either way. Let's break it down further into the profit margin times the asset turnover ratio, which is net sales over assets. Okay, and look at the formula. Profit margin is operating income divided by net sales. Now again, back in financial accounting we said net income. Here we're going to use operating income. Operating income divided by your net sales. That's your profit margin. Asset turnover ratio is net sales divided by invested assets. Okay, notice how net sales cancels out, leaving us with the numerator operating income and the denominator invested assets. Okay, the profit margin tells us for each $1 of revenue, how much profit did we make? The asset turnover ratio says for each dollar we invested in assets, how much revenue do those assets generate? And by combining the two, we say for each dollar invested in assets, how much profit are they generating? Okay, let's take a quick example. Net sales, $2 million. Operating income, $400,000. Investment in assets, $800,000. So my profit margin would be, and it might have gotten cut off on your slide there. Let's see, operating income, $400,000 divided by net sales of $2 million, 20%. Asset turnover ratio, net sales of $2 million divided by invested assets of $800,000, 2.5 times, or 2.5 over 1. And rate of return is my operating income of $400,000 divided by assets of $800,000, 0.5. And we notice 0.2 times 2.5 will give us 0.5. Okay, so your rate of return is profit margin times the asset turnover ratio. It's something worth knowing. All right, now, the second method we look at is called residual income. And let's read this slide here. I'm going to talk about this. If a company uses a minimum required rate of return, which is a percentage, the company may say overall we expect 12% as a minimum required return on an investment, or else don't invest. So for example, some companies might say the cost of capital, which is the cost for us to borrow money from the bank, is one possible definition. If we cannot at least cover our interest costs, why would we want to invest in this? Usually, the minimum required rate of return is going to be higher than your cost of capital or your cost of borrowing. But that number would be provided to you. This is the minimum required rate of return on this investment opportunity. If we don't think it's going to meet that, we're not going to invest in it. If we're looking at alternative A, B, or C, we're going to compare those to the minimum required rate of return. Now, if a company uses minimum required rate of return as a measure of performance, then a manager may not want to invest in an opportunity that would be profitable for the company, but it may lower that particular division or department's rate of return. Okay? And this is why we have the residual income method to evaluate performance, because it addresses this potential conflict between department and overall company. Let's take a look. Residual income is my operating income minus the minimum required income. How do we define minimum required income? Now, I gave you two different terms. I want to make sure you separate them in your mind. If you have to hit pause, write it down, whatever, do so. Minimum required rate of return. A rate is always a percentage. Minimum required income, this is a dollar amount. The definition for minimum required income is your invested assets times the minimum required rate of return, which I just use MRR. Okay, let's take a look at this example. A division's return on assets is 20%. This is their actual performance. They earn 20% on assets, and they may be evaluated based on their rate of return. The company, overall, the parent company, believes that any investment that exceeds a minimum required return of 15% is desirable. And we have an opportunity to invest in, maybe it's buying another company, building a factory. We believe that we're going to have an expected rate of return of 18%, and this would be good for the overall company. But if that investment is going to fall under the responsibility of this particular manager, they're saying to themselves, wait a second, we expect an 18% return. I'm already earning a 20% return. That's going to drag my overall performance down, and my performance is going to suffer. They're going to say, hey, your performance dropped. I may not achieve a bonus, a raise, whatever it may be. That's going to discourage me from investing in an opportunity which the company believes is a good one. Using residual income will encourage this manager to take advantage of the opportunity. Okay, so my minimum required rate of return is 15%. That's the company-wide MRR. Now, the expected cost of this investment is $250,000, and based upon my projections, I expect income from operations from this investment to be around $45,000. Now, I have to give you this information. Notice, expected income from operations, $45,000. My minimum required income, which we know is investment in assets times the minimum required return, MRR, would be $37,500, 250 times 0.15. Therefore, this investment would beat that minimum threshold of performance. My residual or leftover income, or income in excess of the minimum required return, is $7,500. Okay, again, I think I'm going to make $45,000. I have to make at least $37,500, and the way I calculate that is I take the cost of the investment times the minimum rate of return, and I would get $37,500. Since we beat that, we say, hey, this is a good investment. So if this manager is evaluated based on residual income, they're going to take advantage of this, whereas if they're evaluated based on rate of return, and this investment would drag their performance down, they would hesitate. And this is why we have residual income as an alternate measure of performance. Okay, so you should know both those methods. Last couple of items. More and more companies now are recognizing that although you have to ultimately have financial performance, it's kind of like the tail wagging the dog. And what I mean by that is you don't say, this is how I want performance, make it happen. You say, let's make sure we're building a quality product or service. We're giving excellent customer service. The way in which we develop our services and products enhances growth. We treat our employees fairly. We train them properly. We are always investing in new ideas and exploring creativity and encourage people to take risk, because this is where new ideas come from. And so the concept of a balanced scorecard says, let's break down performance evaluation into different areas. Now, different companies may choose different categories, and how they define these areas may differ from company A to company B. But in broad terms, generally speaking, we have these areas. Then again, different textbooks may call them a little bit differently, but you should be able to recognize. So in the area of learning, growth, and innovation, things such as our investment in R&D and our hiring and training practices, make sure our employees really know what they're doing, have access to resources so that they can do their job the best they can. How often do we come up with new products, etc.? Okay, this is an important area because new products are the life's blood of many companies, especially high-tech and pharmaceutical companies. Your internal business processes, okay? How quickly we go from manufacturing, starting the product, to finishing it, to getting into the hands of the customers, okay? How much waste or scrap we generate, the less the better. Waste is inefficient. Inefficiency costs us money. The number of defects, rejects, remember internal failure, when we have problems that we identify either in work in process, raw materials, work in process, or finished goods, if we can address that and minimize or even better eliminate it, then we're improving the efficiency and quality of our product, getting it to our customer more quickly, how fast we get it to them. Okay? This all has an impact on how well our business does. Customer satisfaction. This is really the big area because the customer satisfaction is a function of the learning, growth, and innovation and your internal business processes. And, of course, downstream, after we've made the sale, are we supporting them? Tech support, any maintenance. Okay, for example, Toyota's service department. How often do you need to bring your car in? How quickly do they service it? Okay, if you have a computer problem, getting it resolved, your server's not working, you have to get relinked to the internet, whatever it may be. Is it a frustrating experience? Hopefully it doesn't happen often, and when it does, they get you back up and running relatively quickly. Okay, that affects your reputation. Reputation and customer service also affect customer loyalty. Do you have repeat customers? And then all three of these ultimately impact financial performance. If you do the first three well, the financial performance should follow suit, unless you're charging too much or unless it's a luxury item, and this is where economics and marketing kind of all mix in. There's no guaranteed formulas. Generally speaking, though, a company with good customer satisfaction, good processes, attention to innovation and growth will generate good, solid financial performance, which we've seen some of the measures: profit margin, residual income, rate of return, etc. Okay, so the balanced scorecard says we don't just measure financial performance, we consider the non-financial or qualitative factors that impact financial performance. Last area of discussion is the concept of transfer pricing. And what this means is, how much should Division A sell either raw materials or a part or component to Division B, instead of Division B buying it from an outside company? Example, if General Motors owns Chevrolet as well as AC Delco batteries, then GM, the parent company, would rather Chevrolet buy the batteries from AC Delco than from Sears, Diehards, or whatever other batteries are out there that are not related to GM, because this way we carve out that middleman profit. The problem is, and not really the problem, the challenge, is that Chevrolet and AC Delco are investment centers. They're evaluated independently as if they're their own company. So Chevrolet, of course, they wish AC Delco well, but when push comes to shove, it's their own bottom line that they're concerned with, and vice versa. So GM has to provide an environment in which both companies can satisfy AC Delco's desire to make a profit, Chevrolet's desire to make a profit, and GM overall saving money by having those two work with each other rather than going to an outside third party. So a negotiated price should be somewhere between AC Delco's variable costs on the low end and the market price for batteries on the high end. Okay, and think about it. If AC Delco has a big factory, then if they are operating at 100% of capacity, then they should not sell batteries to Chevrolet at lower than market price, or else they're going to be giving up sales to Ford, Chrysler, Toyota, Honda, or whoever, Chief Auto Parts, whatever auto parts companies are out there. So when they're operating at full capacity, you have to sell it at market price, or else you're going to lose money. But if they have excess capacity, they're not operating at 100% capacity, then they can afford, they're not going to hurt, they're not going to cannibalize is the term they use, they're not going to hurt their existing sales. And they want, of course, they'd love to sell Chevrolet batteries at market price, but Chevrolet doesn't want to pay market price, or else why buy it from them? Buy it from somebody else. So if Chevrolet insists on paying too low a price, it doesn't make sense for AC Delco. So AC Delco says to themselves, well, our factory's not going anywhere, so we're going to incur all those fixed costs. Okay, we have all these sunk costs, the factory, the machines, property tax, insurance, straight line depreciation, etc. However, to sell Chevrolet batteries, I'm going to incur direct material costs, direct labor costs, and variable overhead costs. So those are my variable costs. I have to charge them at least what my variable cost is to make those batteries, or else it doesn't make sense for me. Now, I'd like to charge more than that because I'd like to make some profit. So somewhere in between AC Delco's variable cost and the market price, what they would sell to other companies, is what we call the transfer price. And how a company determines transfer price differs from company A to company B to company C. And I'm not going to ask you to come up with an appropriate transfer price, other than to say, for you to recognize that it needs to be greater than variable costs for the provider or the seller, and it has to be less than the market price for that product, so that both parties will come to terms. Okay, that will do it for this lecture.